Thank you, everyone, for joining us. We're pleased to have Bernie Manbake with us today. Bernie is the two-time former director of the South Carolina Department of Revenue and currently practices law with the firm Nexon Pruitt. With no further ado, here's Bernie.
You. Thank y'all all for joining us today, and we're on Rotary time. We will end at noon regardless of where we are on the presentation. So before I get into opportunity zones, a few quick updates. One, I have 3 listservs for any of y'all who are interested. One listserv is for economic development, and sometimes that's helpful for you with your clients, because you've got a listing and the potential purchaser is looking at it hard, but they haven't pulled the trigger, and all of a sudden I send a clipping out that South Carolina is best in the nation for commercial real estate development. Then you would send that clipping to your client. So that's the economic development listserv. I have a state and local tax listserv, which is not for most of y'all. And then third of all, I have a realtors listserv. It's kind of focused on both realtors and real estate development. And the one advantage of being on it is you get notices of the seminars. So we do a number of seminars. They're all free. We do seminars that are certified by LLR, which we typically hold in the late spring for realtors. And our seminars are exclusively focused on commercial and industrial real estate development and not on residential. So you get some free LLR certified training. And so if you're on my realtors listserv, you'll automatically get that. We're having a seminar coming up on tax incentives for commercial real estate development. It's actually going to be on Friday, February 15th here at the firm. It's free. It'll be LLR certified. And I'll send notices out on that, and we're not taking RSVPs yet. So we'll go over things like the abandoned buildings tax credit, more on opportunity zones, fee and lieu, multi-county park, and that kind of thing. Switching gears, flood insurance. While you may not be following the flood insurance reauthorization, your banker is, I can tell you that. So the flood insurance legislation, or the Flood Insurance Act, expires on December 21st. So it was scheduled to expire 2 weeks ago, and Congress very bravely gave it a 3-week extension. And so the danger of December 21st is, it's in the heart of both the Christmas season, and Congress is in, undergoing a change in the House from Republican to Democrat. So I think everyone's a little nervous about what's going to happen, but the flood insurance expires on December 21st. One last thing before we get into it is ATI. The deadline for filing the ATI exemption is January 30th of next year. So real estate projects that closed 2018, if they were classified as commercial in the hands of the seller, and they're classified as commercial in the hands of the buyer, then you should file the ATI exemption application, and it has to be filed no later than January 30th of next year. And so I call that legislation Nick's Law, because Nick Kremitis was the main person in getting it passed. And it applies where the purchaser purchases it for significantly more than what's on the property tax roll. So if you purchase property for a purchase price that's significantly more than it was subject to property taxes value, then you can exempt up to 25% of the value of the property. That exemption is very widely overlooked, and counterintuitively, it's most often overlooked in the largest transactions. Why? Because in the largest transactions, they're using the purchaser's usually in a large national law firm, and he's not aware of it. ATI exemption is not on the assessor's website in most cases. You gotta search for it. Even though it's not the realtor's responsibility, you really should alert where you represent the purchaser. You should really alert the purchaser to it, because when the purchaser gets the bill next year, he is going to be furious. And is he going to blame himself? No. He's going to blame everybody around him, including you. So if you have particularly your institutional clients, I would alert them. If you haven't filed the ATI, you got to file it by the end of next month, or you lose that. Now, I represent a real estate developer who filed it a year late in Dorchester County. The assessor turned it down, filed a year late. We appealed it, went before the administrative law judge, and we prevailed. But the county, however, appealed that to the Court of Appeals, where it's sitting now. So on large real estate projects, even if they've missed the deadline, i.e. they purchased their property in 2017, it's well worth their time and effort to apply late, be turned down, and then file an appeal, because otherwise the ATI exemption lasts 5 years, and if you don't do it, you lose those years. So turning to opportunity zones was the brainchild of South Carolina Senator Tim Scott. I was initially quietly skeptical of it. I say quietly because I'm buddies with Senator Scott, and I didn't want to openly say anything negative of him, but I was very skeptical of it. It was going to be like a lot of federal tax incentives. It just simply was not going to work, like empowerment zones. There's a bunch of them you've never even heard of because they have not worked. Where I went from skeptical to being a believer in it was when the IRS said you could self-certify as an opportunity fund. You didn't have to go through a CDE. And so when the bill passed, we all know you had to be a qualified opportunity fund, but we didn't know how you became one. And there was a common assumption that you had to, there would be a process very similar to new market tax credits where you had CDEs that would apply. And what are the odds of me giving my money to a do-gooder CDE, which has never done a successful real estate project, and giving them my money on an unsecured basis? And the odds of that are 0. And so I predicted it just wasn't going to work. Well, the IRS said you can self-certify. So instead of the do-gooder CDE, it's now the Maybank Opportunity Fund. And so the self-certification was a huge plus. So we're going to get into the PowerPoint now, but let me first of all tell you how it works at a high level before we get into the PowerPoint and the lawyering and all that stuff. So here's how it works at a high level. And my slides are based, there's a number of qualifying businesses, but my slides are done exclusively for a commercial real estate project. We're either going to build a new building or you're going to renovate an existing building. It's a lot more straightforward when you do that. So let's suppose I want to build a small office building, and I'm going to pay for it with $2 million in equity, and I'm going to get $1 million mortgage. So I'm fortunate enough to own Wells Fargo stock with a basis of $1 million. So I sell it for $3 million for a $2 million capital gain. And by the way, some of the gloss is already off the opportunity zone because with the decline in the stock market, a lot of capital gains have disappeared, or potential capital gains have disappeared, but there's still plenty of them out there. So my basis in my Wells Fargo stock is $1 million. That's what I bought it for. I sell it for $3 million. So I have a $2 million capital gain. Now the capital gain tax rate is either 0%, 15%, or 20%, depending upon my income. So let's say I sold the stock in 2018. When I file my tax return on April 15th, 2019, I'm going to have to pay capital gains on that, the $2 million capital gain from the Wells Fargo stock. Now, the amount of the capital gain is either 0%, 15%, or 20%. And we're talking about long-term capital gains here. So if I, as a married household, if I made $77,200 or less, capital gains rate is 0. If I made between $77,201 and $479,000, the capital gain rate is 15%. If I made $479,001, the capital gains rate is 20%. And there's about 3 different capital gains rates, single person, married person filing separately. So let's say I'm in the 20% capital gains rate. I made $480,000 this year when I file my tax return. So I'm going to be in the 20% capital gains tax rate. So I owe the IRS $400,000, $2 million capital gain, 20% capital gain tax rate. I owe the IRS $400,000. So the way the opportunity zone kicks in is, first of all, I defer that capital gain by investing that $2 million into an opportunity fund. So off the bat, I have made a significant savings. Rather than writing the IRS a check for 400 grand, I just file a form with my tax return on April 15th, 2019. So I have deferred sending the IRS a check for 400 grand. Now, the capital gain is not eliminated, but it's deferred, and that deferral is a wonderful thing. The second good thing that happens is that capital gain is reduced either 10% if I hold the opportunity fund investment for 5 years. So instead of stroking them a check on 2026, December 31st, 2026 for 400 grand, I would stroke a check for 10% less, or $40,000 less. And then if I held my interest in the opportunity fund for 7 years, I would my capital gain reduced by 15%. So then I've invested the money in the opportunity fund. The opportunity fund is built the Maybank commercial office building on Orange Grove in Charleston. If that opportunity fund, if I maintain my investment in the opportunity fund, which holds the building for 10 years, I can sell it totally capital gains free. So that's what I call the second capital gain, and obviously might not necessarily be a capital gain, but if there was one at the end of 10 years, I would sell it totally capital gains tax free. So that at a high level is the incentives for the opportunity fund. I'm going to go through the slides to give it to you in sometimes painful detail. So the opportunity fund was done by Senator Scott and Senator Cory Booker. And one reason they did it, in the 1990s, half or more of all counties grew at the national rate. Now only 25% do. And so for many parts of the country, notwithstanding we're in the greatest economic boom in history, many parts of the country are stagnant. So the opportunity fund, the program is intended to provide a bunch of incentives, which we've gone over, and I'll go over into them in detail. The opportunity funds were determined in South Carolina by local input. So the governors were allowed to designate up to 25% of their low-income housing tracts, and South Carolina, you could do either through data or local input. In South Carolina, we did it through local input. So we have in South Carolina 1,097 census tracts, 538 were eligible to be submitted. We submitted 135 tracts to hit the cap. And so local government sent in applications to the Department of Commerce, and the Department of Commerce then made the decision which would be done, and they were certified. So the U.S. Department of Treasury has to certify the zone, and the South Carolina was one of the first states in the nation that they certified. And here is a map of the certified zones, and at the bottom there is the website to pull up these maps and the zones themselves. That's the Department of Commerce website map. And so by hitting that fcopportunityyzone.com, it'll take you to maps. The zones are not going to change unless Congress alters the law in the future. But as the law currently stands, those zones are going to remain in effect through the life of the program. They're not going to be added or subtracted. So the opportunity zones really took off on October 19, 2018, when the Treasury Department issued their first set of regulations. These are draft regulations, but at the end of the draft regulations say you can rely on them if you apply the rules in their entirety and do so in a consistent manner. You've grandfathered in, even if the regulation changes in an anti-taxpayer fashion. So you basically can grandfather in. So there's 3 requirements to take advantage of the program. First of all, you have to have a capital gain. It must be invested in a qualified opportunity fund, which invests in a qualified opportunity zone. And if those three things happen, federal income tax incentives are generated. So the qualified opportunity zone we just went over, there are an amazing number of them. I think Richland County alone has 8. Charleston has about 8. Charleston has a downtown, very affluent downtown opportunity zone district. How did they qualify? Because most of the people living in there were students with very low income. And so it's surprising where some of the areas are. So of the 3 requirements, we've already been over the qualified opportunity zone. That's on Commerce's map. That's not going to change. The zones are readily pulled up. So actually, I'm going to go out of order and start with the tax incentives. So to repeat them, there are 2 forms of federal income tax incentives. There's a deferral and possible reduction of the original capital gain. That's the sale of my Wells Fargo stock. And then there's the elimination of the second capital gain, if any, from the subsequent sale of the investment in the opportunity fund. So when the Maybank Opportunity Fund LLC sells the commercial office building, and if we sell it at a capital gain, we hold it for 10 years and we sell it at a capital gain, there's no capital gains taxation on the sale of the Maybank office building. So the 2 income tax incentives is we've been over now for the 3rd time, is a deferral of the $400,000. So I gotta pay that deferral on December 31st, 2026. I gotta stroke a check to the IRS for that money on December 31st, 2026. But the deferral is like the 1031 rollover. A deferral is a wonderful thing. I'd much rather write the IRS a check for $400,000 on December 31st, 2026 than to write the check today. So the deferral alone is a wonderful thing. Second of all is a capital gain reduction. So if I sell my Wells Fargo stock, I put it into the Maybank Opportunity Fund LLC, and we meet all the other requirements of the act, which I'll get into, then I pay 10% less of capital gains if I hold it for at least 5 years. So it would be 400,000 times 40,000. It would be a 10% reduction in the check I'm writing to Johnny Fed, so to speak. And if I hold it for 7 years versus 5 years, I have a 15% reduction. So a 15% of 400,000 would be less 15% of 400,000 would be what I would be stroking the check to the IRS on December 31st, 2026. Now I'll predict, so December 31st, 2126, I'm sorry, December 31st, 2026, people are going to have to stroke a lot of checks. I will predict that Congress, and I don't care if Senator Warren is the president then, Congress is very likely going to extend that deadline. There will be intense pressure to extend that deadline. So I will predict in 2026 that deadline is going to be extended. And I don't care if it's an all Republican Congress or an all Democrat Congress, they're going to extend that deadline. But if they don't, you're going to have to stroke a check on December 31st, 2026. Then, because the timeline's already running on this bill, in order to get the full 15% capital gains reduction, you got to invest it by the end of 2019. So the second capital gain is, I mentioned, the Maybank, the opportunity. I take my Wells Fargo stock, I sell it, I invest that dough into the checking account of the Maybank Opportunity Fund LLC. The Opportunity Fund LLC either builds a brand new building or buys an existing building and renovates it. If we hold on to that for 10 years, there's no capital gain when the Maybank office building is sold when it's sold for 10 years. So first of all, you go back over it, you got to have a capital gain. So it could either be a short or a long-term capital gain, but you got to reinvest it within 180 days in a qualified opportunity fund. So 180 days sounds like a long time, but the clock furiously flies. So if you have a client that 150 days ago had a substantial capital gain, and by the way, there were a lot more capital gains 150 days ago than there are today. But if he sold his stock or his real estate 150 days ago, he or she has got to start furiously think about putting it into a qualified opportunity fund. Now, in my example, my Wells Fargo stock is going into the Maybank Opportunity Fund, LLC. I'll self-certify that as a qualified opportunity fund. And by far the simplest way to do it on real estate projects, each new real estate project should be its own SPE. It should be its own SPE, and developers do that anyway. Every building is its own LLC. And in this case, every building is going to be its own qualified opportunity fund, LLC. So the other little nuance is if the capital gain is a result from the sale or exchange of real estate, it's got to be with an unrelated party. So you can't sell real estate to yourself and generate a capital gain for purposes of taking advantage of the opportunity fund. And the definition of a related party is broader for purposes of this act, meaning there are a lot more related parties in this act than there is under the normal tax law. So can't be a related party, and the definition of what is a related party is broader for purposes of the act. That only applies to sales of real estate. When you sell your stock in the stock market, you don't have to worry about any of that. Any entity that recognizes a capital gain can be qualifies. So obviously individuals, but it's a lot broader. C corporations, REITs, partnership, S corporations. If they've generated a capital gain, then they're eligible to invest in an opportunity fund. There are a few gains that are not capital gains. And so 1031 like-kind exchange is not, for example. You have certain partnership transactions, and then you have in divorce, for example, you can have a gain, but it's not a capital gain. Those are rare, so you really don't need to worry about those. The partnership transactions are probably the only kind that will really rear their head. And you can split your capital gain. When the legislation was originally passed, there was a belief that you could only invest once in the opportunity fund. So in my example, where I have a $2 million capital gain, there was a belief that I either had to strike a check for $2 million to the Maybank Opportunity Fund, LLC, and if I stroked it for $1 million, I couldn't change my mind and put the remainder of the $1 million into it within 180 days. And so the Fed says yes. You can do it in multiple transactions. It doesn't have to be a single check. With partnerships, the IRS gave a pro-taxpayer ruling. So let's say the partnership generates a capital gain. They sell a building or they sell stock. Most often they would sell a building. The partnership may decide we don't want to roll over that capital gain into the Maybank Opportunity Fund or into the Partnership Opportunity Fund. They may be quarreling with each other. They may have different ideas of what to do with the money. So in that scenario, the IRS says the individual partner can roll his or her share of the capital gain. So it doesn't have to be done by the partnership. The individual partner can roll over their share of the capital gain. So how do you defer that gain? I've got a choice of either stroking a check to the IRS for $2 million or filing a simple Form 8949. And that form would be filed next April 15th, or in my case, I barely get it in October 15th. So rather than, I ain't stroking the check for the IRS to 400 grand, I'm just filling out IRS Form 8949 and attaching that to my income tax return. You can stack the incentives with both state and federal other credits. So for example, the abandoned building, there's probably a fair number of abandoned buildings in opportunity zones. So if the Maybank Opportunity Fund LLC buys an abandoned building, it can get a tax credit of 25% of the renovation cost. That building had to be abandoned for 5 or more years, 66% of that building had to be abandoned for 5 or more years. If 66% of it had been abandoned for 5 or more years, I've got to do a little bit of lawyer, and the Maybank Opportunity Fund is going to have to file a form with the DOR, but 25% of those renovation costs are a state tax income tax credit. So the income tax credit base does not include the acquisition cost, and it doesn't include personal property, but it includes, it's 25% of the renovation expenditures, and the renovation expenditures only after you file the notice. So you got a deadline running on it. So I can do that in the opportunity zone, get all of the federal tax credits under the opportunity zone, and get the state income tax credit under the Abandoned Building Act. If I'm doing a project that the county would love, for example, building a commercial office building or a hotel in a area that the county is trying to renovate, the county could give me a fee in lieu, a multi-county business park, and a special source credit. So the special source credit is a dollar-for-dollar reduction of the property taxes. So I've represented 3 student housing developers, for example, in Columbia, and they committed to investing $45 million, and they got a 50% special source credit or a 50% reduction of their property tax bill. Why? Because the city was tired of dorms being built that were totally property tax free, and so they figured 50% of the taxes is better than no taxes, and so they recruited student housing developers and built the dorms. So you can do a fee in lieu multi-county business park and a special source credit on a building that's in the opportunity fund, and that is a reduction of the property tax bill. The Bailey bill freezes the property tax value. So if you had a historic building in an opportunity zone and the city recognizes the Bailey bill, not all cities do. The city of Charleston, for example, does not authorize the Bailey bill. But the Bailey bill freezes the property tax value at the pre-renovation cost. So if the building was on the property tax rolls for $1 million and you planned on putting $3 million into it, normally the property tax base would be $4 million, the original cost plus the renovation cost. Under the Bailey bill, the property tax value for 20 years is $1 million, the pre-renovation cost. So you have to get that approved, of course, but it's obviously well worth it. So an historic building in the opportunity zone, you can do the opportunity zone incentives, and you can do the Bailey bill. And by the way, we're going to be going over all of these things on our seminar on February 15th. So the capital gains has to be invested within 180 days. Well, and the investments must be in cash. So I got to stroke a check to the Maybank Opportunity Fund. I can't give it a promissory note. But when I sell my stock and the stockbroker gives me the check for $2 million, I would deposit that in the Maybank Opportunity Fund LLC checking account. So to those of y'all who have clients whose trade went through 175 days ago, you gotta get cracking, because you got to set up an LLC, and then you got to open a bank account. And opening a bank account, you got to get an EIN number, etc. So when does 180 days start? For stock, it's the recognition date, basically the trade date. Any entity, basically, to be an opportunity fund, you got to be either a corporation or a partnership, And so everybody assumes an LLC, which is taxed as a partnership, would qualify. They could be also done as an S corporation, but most people are going to do the opportunity fund as an LLC. As I've mentioned, that the original thought was opportunity funds would have to apply like the new markets tax credits does as community development entities, and that was a big negative. I'm not going to give my dough to a community development entity. And the IRS said, no, you self-certify as a opportunity fund. And they said that in October, and that's when things really exploded. You saw Goldman Sachs set up an opportunity fund, so it's really exploded since the IRS says to self-certify. So the Maybank opportunity, if I sold my stock 160 days ago, I'd frantically scramble. I would file an LLC paperwork with the Secretary of State's office, quickly open a bank account, which requires an EIN number, and then to self-certify, I just have to complete a form and submit it to the IRS next year. So when I file my income tax return next year, I would self-certify. So the IRS has repeated, you self-certify, and that's a huge thing. So in order to be a qualified opportunity fund, at least 90% of the Maybank's LLC assets has to be in qualified, and we're going over purely qualified opportunity zone property. So there's other things you can invest in. Maybank LLC could invest in stock, partnerships, zone business property. And so we're going to discuss zone business property. So basically, the Maybank Opportunity Fund LLC is going to have to either build a new building or substantially improve an existing building. And an existing building or a new building be commercial buildings, equipment, multifamily complexes. It's basically any real estate except for several that you can't do, which I'll get to in a minute. So we'll explain that. So here is the requirements. So the Maybank Opportunity Fund LLC, substantially all of its property has to be qualified opportunity zone business property. And where the Maybank LLC is going to own a single business, we satisfy that without any worries or concern whatsoever. 50% of the business gross income has to be derived from the active conduct of the trade or business. And because, again, we're setting up an SPE, we're setting up an LLC that's going to own nothing but this business, we don't have to worry about that. The Maybank Opportunity Fund LLC is not going to be getting stock dividends and things of that nature. The less than 5% of the Maybank Opportunity Fund's balance sheet is in financial property. Now, what's financial property? Cash. So, and we'll get to this in a minute. That 5% was a real problem because you measure what the basis of the Maybank Opportunity Fund. You have to measure it twice a year, June 31st and December 31st. Well, for the first period of time, the Maybank Opportunity Fund, its sole assets would be cash. And so it can't be more than 5%. Well, how on earth do we get around that? Can't be more than 5% when in fact it's 100%. So we'll get to that in a minute. And then it can't be a sin business. Now this list of sin businesses came from the New Markets Tax Credit Program. Senator Scott didn't make these up. So it can't be a private or commercial golf course, can't be a country club, can't be a massage parlor, hot tub facility, suntan facility, and you can see who doesn't have lobbyists in Congress. Massage parlors, hot tubs, and suntan, drop the lobbyist ball there. Can't be a racetrack or other facility used for gambling, or any store, the principal business of which is the sale of alcoholic beverages for consumption off premise. So a hotel and a restaurant which sells beer and wine on premises qualify. A C-store, which has a license just to sell off premises, does not qualify. So basically, the Maybank Opportunity Fund LLC can either build a building or substantially renovate a building for just about any purpose other than golf course, country club, massage parlor, hot tub, suntan, racetrack, or C-store. So substantially all of the property must be qualified opportunity zone business property. Again, if we follow my guideline and we have an SPE, the only thing the Maybank Opportunity Fund LLC owns is that one commercial office building. Then we don't have to worry about this. You've got the property has to be acquired after 2017. So where we deal with new building, you're going to meet that every time. Where you're going to renovate a building, you had to buy that building after 2017, and that's a problem. You know, you've got an existing building, that could be a problem there. The original use commenced with the Qualified Opportunity Fund. That basically means the Maybank LLC either built the building or substantially improved the building. The Maybank LLC couldn't just simply buy a building. So we either got to build a new building or we got to substantially improve it. And I'll get into the substantial improvement. So the Maybank Opportunity Fund is measured. Are you qualifying with the Act? Is 90% of your assets qualified property? It's measured twice a year. So for a calendar year taxpayer, it's measured, you know, June 30th and then December 31st. So where the Maybank Opportunity Fund owns only a single building, then this test is not a problem at all. Where you have a mutual fund that owns multiple properties, then you have to start worrying about this test. But if you use the CPE, the SPE, you're not going to have a problem with that. Now, of course, you have a problem in the initial stages. This being tested twice a year, and 100% of the assets for the first 8 months is cash. And the Act says you can only have 5% of your assets in cash. Well, the IRS gave very pro-taxpayer advice on that in October. So it's got to, as I've said, it's got to invest 90% of the fund in real estate or construction or improvement within 6 months. Well, nobody can do that, and the fund can't only hold 5% of its assets in cash. Well, the IRS gave a working capital safe harbor. So under this, all the Maybank LLC has during those, it's being measured twice a year, all the Maybank Fund LLC has for a considerable period of time is cash. So it flunks that test every 6 months when you test it. But the IRS has said that you can have it in cash for up to 31 months if there's a written plan that identifies the financial property as property held for the acquisition, construction, or substantial improvement of the Maybank office building, which is going to be in an opportunity zone. There's a written schedule consistent with the ordinary operations of the business, and you substantially comply with it. So again, we flunked the test, and we flunked the test for 26 months, but so long as we have that written plan, we're fine, so long as the building is either built or there's a substantial improvement within 31 months. So as a practical matter, I've told you 180 days, when you sell stock or you have a capital gain, you have 180 days to invest it into an opportunity fund. So you scramble and put together the opportunity fund. And the opportunity fund, I've mentioned that it's measured twice a year for its assets. It's got to pass a test twice a year. Here, as a practical matter, if it's cash, you got 31 months to decide what to do with it. It's got to be building's got to either be a brand new building or substantially improved. And this was a second very pro-IRS, very pro-taxpayer determination by the IRS. And this is what's also got people a lot more interested in the opportunity fund. So brand new building, we don't have to worry about anything. Substantial improvement though, well, what's the definition of substantial improvement? Basically, you put more into the renovation of the building than you paid for it. So if you bought it for $1 million, your substantial renovation bill has to be $1,001. And so that's simple enough. And remember, the whole purpose of this act is to generate that renovation. So that's why it's got to be the 100% test. You've got to renovate it, spend more on renovation than you bought it for. And that's the whole purpose of the act, is to incentivize you to do that. Well, the IRS gave pro taxpayer ruling on where you buy both raw land, dirt, and a building. So the question is, what is substantially improved when you buy very expensive raw dirt and a modest building, for example, which is, say, in Charleston, where the dirt is very expensive. So let's say you bought, you pay $5 million for a building and dirt. The tax collector, the assessor, says that of that $5 million, $4 million of it was the value of the land, and $1 million of it was the value of the building. So what is substantial improvement? Is it $5 million and $1, or is it $1 million and $1? Is it substantially improved means you spent more than the purchase price, or of the entire tract? Or does substantial improvement mean you just spent more than the value of the building? The IRS says it's just the building, and they give you an example in a revenue ruling. So in my example, you spent $5 million on it. According to the assessor, of that $5 million, $4 million of it was raw dirt, and $1 million of it was the building. You've only got to spend $1 million and $1 renovating the building, and you've complied with the requirements of the act. And they also said you don't have to worry about the dirt, ever again. The $4 million in the dirt, you do not have to construct anything new. You don't have to, basically, you can ignore the $4 million for purposes of what is substantial improvement. So the IRS goes on and on in a very pro-taxpayer fashion, and this is just too painful to read, but they gave an example, which is always very good, so we can see exactly how it works. Then there's additional proposed regulations coming. The IRS in October, at the end of October, they answered the two biggest ones, which is, how on earth am I going to build a building or substantially renovate a building in a 6-month period, which is where, the Opportunity Fund gets measured twice a year. It can only have 5% of its assets in cash. It's got 100% of its assets in cash. So it's going to flunk that test every time they measure it. But you've got 31 months for the LLC to either buy a building, stroke a check to buy a building, or start paying contractors to renovate the building. So that was a big plus. That safe harbor for cash was a big plus. And then second of all, people didn't understand or weren't sure what substantial renovation meant. In my example, do you have to spend $5 million and $1, or do you have to spend $1 million and $1? And the IRS says you only have to spend $1 million and $1, and you never have to build anything on the dirt. We basically ignore the $4 million for purposes of the substantial renovation. So that's how the IRS is going to give additional. They're going to issue additional regulations in today's paper. The New York Times quoted President Trump as saying he's going to direct federal agencies to try and put more money into opportunity zones. So the IRS is going to issue additional regulations. If you do, as I've said, if your opportunity fund only owns a single asset, then there's really these questions, the remaining questions really relate to mutual fund, where the opportunity fund is basically a mutual fund, investing in multiple properties. So if you have a SPE for your building, there's not a whole, there's always some questions, of course, but there's not a whole lot of questions remaining in that regard. So I'm gonna turn now to any questions that y'all have. Let me run back over a couple of the things I've said at a risk of being a complete broken record. One, ATI, that deadline is next month, the end of next month. And to qualify for the ATI, you got to have three things. The seller had to use the property, had to be taxed as commercial. The buyer has to use the property taxed as commercial. And the property had to sold for more than the and there's no bright line tested as what's more than, but it's got to sell for more than the property was valued for property tax purposes. And I can tell you, if that ATI application is not filed and it's not clear who's got to file it, does a closing attorney for the purchaser have to file it? Does the owner have to file it? There's no real track record of, well, whose responsibility is to file it? And the ATI is not on the assessor's website. So the huge national law firm that closes a deal, they've never heard of it, and they probably don't view it as their responsibility anyway. When that ATI exemption doesn't get filed and they get their property tax bill next year, he is going to be furious because he did his due diligence. The purchaser did his due diligence, which basically was to calculate to see what the seller was paying in property taxes. And he knows he's going to pay more than the seller, but he doesn't figure it's going to be any big deal. And it comes in dramatically higher. He's going to be mad at everybody but himself. And one of the persons he's going to be mad at is the realtor. You took this huge commission at the closing. You didn't tell me a word about the ATI. Now it's too late to file for it. And so particularly for your institutional clients, you need to send them at the end of the year an email reminder where you get back. A couple of them will say, I never heard of ATI and I've closed on property 2 years ago. Is it too late? If it's a significant property, file it late, let them reject it, let the assessor reject it, and then appeal it. Some counties actually accept late filings. So get that ATI in. For abandoned building, the deadline for abandoned building is that you cannot, your tax credit base does not include expenditures done before you file the notice. So abandoned building doesn't have nearly as much lawyering as a fee in lieu multi-county park, but it's got some lawyering, and you're making a mistake if you don't do some lawyering. The main lawyering is filing the notice. So you've got to file a notice before you do expenditures, and almost everybody does some expenditures before they do the notice, and that's no big deal. But the expenditures done before the notice is filed with the DOR don't go into your tax credit base. So you want to get that. You want to get that notice in. The building's got to be abandoned for 66% of the building has to be abandoned for 5 years. And it can be a substantial credit. It can be valuable, and it's basically free money. Free money in the sense you don't have to get anybody's permission. You just have to file a notice. A little bit of lawyering, but not a huge amount of lawyering. So it's something well worth doing. And whether or not it's in an opportunity zone, but where it's in an opportunity zone, it's particularly applicable. And then the Bailey bill, start preservation tax credits, those can be stacked with the opportunity zone. And for substantial projects, you may want to look at approaching the county about a fee in lieu multi-county business park special source credit. The special source credit is a dollar for dollar reduction of your property taxes, and the counties will use them to renovate areas that had not, where that needs renovation. I had a county one time trying to recruit a Best Buy. That was before Best Buys were everywhere. And they were going to give a substantial special source credit to the developer who was going to recruit a Best Buy because they were trying to renovate that part of town. And they felt like a Best Buy would attract a bunch of people, which back in the day, they they did. So that's something to think about too. And there's no deadline on the multi-county business part, but obviously your leverage goes down if the project has already been announced. So with that, I'll turn to, do we have any questions on the presentation?
Yes, sir. We have a few. The first question we got is, how does someone subscribe to your Realtors listserv or one of the other listservs?
All you have to do is email me, and my email address is found at the bottom of each slide. And since I got 3 listservs, if you tell me which one you want to be on, probably all of y'all want to be on the Realtors one, but some of you will want to be on the economic development one as well. And then we have another question.
Yes, sir. If a buyer of a building in an opportunity zone does not have capital gains to invest, is there a benefit in doing the investment?
There is. In fact, almost every time I give a speech, I get that question. The benefit would be the sale of the building. You have to hold it for 10 years, but if you held it for 10 years and sold it, you would be selling it totally capital gains free. So you have to put cash into the opportunity zone, but that cash does not have to come from a capital gain. It's better if it comes from a capital gain, but it doesn't have to come from a capital gain.
Yeah, and then we have a question for ATI. When you've been saying the commercial tax rate, does that include anything at the 6% non-owner occupied rate, or is that referred to zoning use?
No, it is purely relating to the tax use. So taxes, if it's primary single residence, it's 4%. If it's farm, it's 4%. If it's a manufacturer, it's 10.5%. So if the property was on the books at a 6% assessment ratio, and in the hands of the seller, usually that's on, not always, but usually that's on the tax bill. So if you represent the purchaser, you can find out what the seller's whether it was at 6%. One question I push people to do is a second home. So if you bought a second home from somebody and it was their second home and you paid a lot more for it than's on the tax rolls, I'd go ahead and file it and see what happens. So the classic example would be Kiowa. If you spent $4 million on a home and it was $2 million, it was the property tax valued at $2 million, and it was the seller's second home, and it was your second home, I think that fits under the act. File the form and see what happens, would be my advice.
Yes, sir. And going back to the 10-year period that you had mentioned earlier, how much cash does someone need to put into the property within that period?
It doesn't. There's no minimum. As with for example, bonds, the economics of the deal just don't work, for a very small transaction. But there's no minimum. But now remember, you've got to substantially renovate the building or build a new building. So for a tiny amount of cash, you're not going to build a new building. And for a tiny amount of cash, you're not going to meet the 100% test. You're not going to the rehabilitation expenditures are not going to be more than you paid for it, unless it's a tiny little building, of course. So there's no minimum, but you got to build a building or substantially renovate it. And so that's kind of, as a practical matter, generates a, minimum cash.
Okay. We had a question. If you get gains from a 1031 exchange, can you sell that property and invest in the gain in the opportunity fund?
Yes. And so it would be a two-step process. So you own, as I understand the question, the property you own today was a 1031 like-kind exchange. If you sell it and generate a capital gain, then yes, that capital gain can be put into the opportunity fund.
We also got a question of what would be the rough sort of lawyering costs for doing the abandonment of a building and with regards to doing an opportunity zone Bailey bill or all the other incentives.
Right. The legal fees vary. The abandoned building, the legal fees really comes from two things: drafting the notice for you, and that notice does require a little bit of lawyering, and may require a fair amount of lawyering if you're trying to get multiple credits. So the tax credit for abandoned building is capped at $500,000, but the DOR in a very pro-taxpayer fashion says you can get multiple $500,000 under certain scenarios for the same building. So if you wanted to pursue that, that would be a little bit more lawyering, but typically you'd be looking in the $5,000 to $15,000 range, something like that. The other thing is that the city or county can now certify the building was abandoned. That is a big deal because it's hard for you to prove that a building was abandoned. So that's a pretty big deal. And so typically you get the lawyer to do that. The lawyer would draft the ordinance that would approve that.
We have one more question. If you own a building in an opportunity zone that's been abandoned for 10 years, it has no tenants, is there any way to stay in the project under a substantial improvement clause?
Yeah, because your substantial improvement. So the Abandoned Building Act does not apply if it was abandoned during your watch. But if you bought an abandoned building that had already been abandoned for 5 years, you could hold it for 5 more years before you built it, or 3 more years before you built it, and you would still qualify. But the 5 years of the abandonment had to take place under the seller. And so it's not always easy to prove that. That's why it's so good that the General Assembly passed a bill that allows the city or county to certify it. So then you could substantially renovate it. And I have to double check that, but my gut tells me you can substantially renovate it even though you own before December 30, in 2017. The act says the transaction has to occur after 2017, but I'm almost sure the substantial renovation, if it happened in 2019, that would qualify, notwithstanding that you own the property prior to that.
Okay. Oh, thank you very much for your time. And this webinar is going to be archived on our YouTube page at youtube.com/SC Realtors. If you have any questions, reach out to the legal department. We can try to relay those to Bernie if we need to.
All right. Well, thank you all.